Our moderator for today is Henk Oosterhout. Henk is a member of the IVSC's Business Valuation Board and a managing director in Kroll's Valuation Advisory Services based in the Netherlands. So thank you, Henk, and now over to you.
Thank you, Richard, and welcome to all from around the world to this new webinar series from the IVSC. This one, as Richard already indicated, about analyzing intangibles. And before I shortly welcome our appreciated contributors to this session, let me put the topic a bit more into perspective, right? As we all know, in the current economies, intangibles are playing a much larger role than, several decades ago. And from the IVSC, the idea that we have for this seminar is to focus a bit more on the role that these intangibles have in a company's performance, and as a result, also in a company's valuation, right? Be it, a market price or be it another value. And in order to give you some more insight into the topic, we have gathered and are very happy to have the contribution of 4 well-known speakers, and let me shortly introduce you to them. First of all, Dominique Rouge. Dominique is a former deputy CFO of Sanofi, and as a result, representing an R&D specific industry. He has currently still a role in several biotech and scientific bodies, focused on biotechnology, technological developments. Secondly, Ralf Smijts. Ralf is the senior vice president group control, in the DSM, Dutch listed company that was, into big news on Tuesday. Then we have Jeremy Stuber. Jeremy is an equity analyst, working at Newton Investment Management and also part of CRUF, right, the Corporate Reporting Users Forum, from the UK. And finally, my colleague, a board member in the IVSC, Kevin Prell, a partner at EY in the US, and also a technical advisor to the Business Valuation Board of the IVSC. Kevin, to you first the floor, and give us a bit further insight on the topic.
Hey, thank you, Henk. I'll give kind of the IVSC kind of perspective, what the organization is doing on this issue. And it just kind of set the stage a little bit, hopefully for kind of further discussion here. So as Henk mentioned, I think we've kind of reached this tipping point where intangible assets are clearly the value driver for enterprises around the world and really most industries at this point. But we've had very little change when it comes to kind of the financial reporting kind of ecosystem. And ultimately, there's very little information about internally generated intangible assets kind of present kind of within the financial statements, whether that's on the balance sheet, coming through the P&L, or kind of management discussion and analysis. But I think the good news is that there has been momentum to try and kind of close this information gap. And kind of the biggest example, which the first polling question kind of addressed, is just that delta between market capitalizations or market value and what you're seeing on the balance sheet. And it's not to say that we need to kind of capitalize the difference and close that gap per se on the balance sheet, but much more effort, I think, needs to go into explaining and understanding that difference, and providing investors with information so that they can assess that difference. We do see a lot of movement on the issue when it comes to the standard setters and other stakeholders, in particular the IASB as well as the FASB both have projects. Very early stage projects, but exploring kind of what they can do to provide additional information on internally generated intangibles. IOSCO and other regulators around the world are very focused on this issue as well. And then I think one big piece of the puzzle is just the movement around ESG. And we have the ISSB newly formed, or the International Sustainability Standards Board, that was newly formed. And when you start to kind of unpack what investors are leveraging within the ESG framework, long-term value, kind of sustainability, a lot of it really focuses around internally generated intangible assets as well. So we're starting to see a lot of movement in this area. And I think from the IVSC, one thing that we've noticed is that all these organizations, as well as investors, are all kind of using the phrase value relevant. So everyone wants to make sure that if there are changes and additions and improvements, that they truly are value relevant, that they're informative to determining kind of the business enterprise value, and helping investors around the world allocate capital most efficiently. So to kind of help facilitate that, what the IVSC has done is currently in the process of preparing and publishing a series of perspective papers where we're going through 4 different kind of groups of intangible assets. The first one that we have published is on human capital. Second will be brand reputation. The third will be R&D and technology assets, which is going to be the subject of this panel, and hopefully something that we can use information here to build upon that. And the fourth will be customers and other relationship-based assets. Really what we're trying to do there is really dissect how intangible assets create value for an enterprise. What are those KPIs that are value relevant? And then also do an analysis of investors and doing that through equity analysts kind of reports to understand what information are they not getting from the current kind of financial or sustainability reporting. Where are they going to get that information? And can that information be brought into kind of the broader ecosystem? So that's kind of the IVSC update. As I said, we're currently in that process. And what we're trying to do is just really further the discussion around this issue, provide a valuation opinion, much like we're trying to do here, is just to facilitate the discussion so that we get to the best possible answer. So with that, Hank, I'll turn it back to you.
Thanks, Kevin. And maybe for the help of the audience to prevent any confusion, when we talk about intangibles, of course, the topic of the session, we have on the one hand intangibles that are already on the balance sheet, for which some information is also given because of their existence on the balance sheet. And let's say roughly, we will refer to them as the acquired intangibles. And then we have some intangibles that are basically, not on the balance sheet, and therefore a driver of the relatively large gap that we commonly see between the market and book values. And those are what we call the internally generated intangibles, right? It's not a full black and white distinction, as everybody knows on the call. But in our way of referring to them, we loosely refer to them as follows. So with that, having said, Jeremy, can I give you the floor to talk a bit more from your side, what you as a investor / potential investor and shareholder in companies, what type of information you focus on when you analyze intangibles?
Thank you very much, Hank. And good afternoon, everyone. So the kind of information I'm looking for is really to answer my kind of fundamental question. And I'm asking, is management allocating capital wisely? So by this, I mean, are they investing in attractive projects? So as an external investor, how do I tell if management are investing in attractive projects? So my first reaction would be, well, surely the more information I have, the better. This may be appealing in theory, but even if management were to issue and publish all the information relating to the projects, I don't have the time as a generalist or the expertise to digest the information. I know years ago I was talking to a finance director about a construction project. It was a very large construction project that was had problems with it. And he tried to reassure me that there's a risk register within the company and they track and monitor the project so they can manage the risk. But even he admitted that even if there was such a detailed amount of technical information, he didn't understand all of it. So in the end, if internal management couldn't understand it, what hope would I have? So I would like to just talk about, in practice, how do I assess whether projects are attractive? And I suppose I use both my non-financial information and financial information. And I'll start with non-financial information. And I think at the bottom of it all, attractive projects are likely to be the result of a healthy attitude towards risk within the company. So firstly, there's management's attitude towards risk. So I really want to understand, how is management allocating capital, comparing internal investments with other options such as acquisitions or returning funds to the owners of the business. is their process based on a rational way? Is it based on good information about risk and return? And maybe an example here highlights this. I was looking at a small aerospace supplier. This was a company supplying small parts to an aerospace engine supplier. Now, aerospace engines are quite a tricky business because the timescales involved are very long. A project can take many years, and the products themselves can be used for decades, both the original equipment and the spare parts. So it's very difficult to understand what's the return on capital. Now, because of the risks involved, and this was a small company, in common with the industry, they enter risk-sharing agreements with other suppliers. So they share the risk of investment and also the rewards of the profits on subsequent sales. Now, the problem I had as an external person, I didn't know the terms of these agreements. How could I be confident that the risks taken by the business weren't excessive relative to the size of their business? So fortunately, I had the opportunity to visit the company on an investor day. And during the coffee break, I asked the head of R&D a lot of detailed questions about the agreements. He didn't answer any of my questions, but what he did said was actually more interesting. He said, "Don't worry, Jeremy. Think of us as a family business." In other words, they consider the long-term health of the business and they don't take on excessive risk. So even though I didn't get numbers back from him, I did get something much more important, which is confidence that they weren't taking on these excessive risks. Another type of non-financial information I really think is important is the culture of the company. And sometimes I ask this question to management: what's the cultural DNA of your business? Could you describe that to me? And this gives me lots of information. And I'll just illustrate this by talking about two extremes. On the one hand, some companies can have too much of an engineering mentality. So by this, I mean the R&D department is too powerful and they're able to demand very large budgets for blue sky pet projects, which are really interesting for them to work on, but the financial prospects of these projects are very dubious. There's one example of a company I looked at that had a series of profit warnings, and it turned out the root cause of the profit warnings at the time were decisions taken years and years before, when engineers were over-enthusiastic taking on these very ambitious projects. And it turned out actually what the information that would have been useful was to see the number of external contractors that they had to subsequently hire, because all the engineers were taken up on these cost overrun projects and had to hire people externally. So that would have been a sign that things were going wrong. So that's one extreme. On the other extreme, you can have too much, I would say, of an accountant mentality. Here, the R&D department would be starved of funding and risk-taking would be actively discouraged. Obviously, this helps boost short-term profits, but it's not very good for long-term growth. So the kind of the golden mean here was, once a company told me that they actually told me very proudly their employees were half engineer, half accountant. So I'm not talking about a cyborg, it's a real person. And I thought this was a very positive comment. It told me that they measure the technical risk and the financial risk and reward in a very appropriate and measured way. So one example of this was for the defense end market again. They were replacing very old defense equipment that was very costly to repair with much newer equipment based on a laptop that was customized for military use. So they were able to invest a small amount to customize this laptop, sell it at a high profit margin, and the customer benefited hugely because they wouldn't have to repair this very old equipment. So they did lots and lots of these small types of projects. And again, that gave me confidence they were allocating profit capital wisely into attractive projects, lots of small attractive projects. So all of that is the non-financial information, but of course I look at the financial information too. And if a company is involved in attractive projects, the result of these attractive projects should be seen as a high and stable return on invested capital. So then the question becomes, how do I calculate the return on invested capital? Now, for a traditional manufacturer, calculating return on invested capital is quite straightforward. The income statement profit is a good proxy for the return on the projects, and the balance sheet net assets is a good proxy for the invested capital. The problem for an R&D intensive company is that it's a lot more challenging to calculate return on invested capital. The income statement profit is not always a good proxy for return on projects. You can take an example of an early stage company. It's got a lot of R&D expenses and no income at all. And the balance sheet assets are not a good proxy for the invested capital because, as Henk said, these internally generating intangibles are not on the balance sheet. Now, the problem here is the accounting. Most of the R&D is expensed in the income statement rather than capitalized on the balance sheet. So I do my best to reverse this and try to capitalize historic R&D so I can calculate the stock of intellectual property in the business, and I include this in my definition of invested capital. So there's two elements to this calculation. One is the R&D expense, and that's disclosed by companies. And the other one is the asset life. Now, this isn't disclosed, but I can use industry averages. So, for example, for the pharmaceuticals industry, I tend to use an 11-year asset life, but for a software company, much shorter, a 4-year asset life. So I can do this, but it's just an initial approximation of the stock of intellectual property in the business. And there are a problem with both numbers. So firstly, on the R&D expense, I don't actually want to capitalize the total R&D expense. Why is that? Well, there's a couple of parts of it that I want to exclude. I want to exclude the depreciation and amortization within the R&D expense because that's already capitalized on the balance sheet. And also want to exclude restructuring expenses because these don't create intellectual property, even though they're part of the R&D expense. And I'll give one example here. It was actually a pharmaceutical company I was looking at. They very proudly showed in all their reports a chart of R&D to sales. I'm not sure if I'm doing this in the right direction, but it was going up and up and up. R&D as a percentage of sales. That was a great sign, investing more in the business. But it turned out that R&D was a total R&D number. When you stripped out the restructuring charge, because they were actually restructuring and reducing the size of their R&D department, the underlying R&D department was falling, giving a totally different impression of the business. So it's very important to know what's inside that R&D number. So in terms of information that would be helpful, it comes to a much better disaggregation of expenses. I really need to have expenses by function, such as R&D, and also by nature, such as depreciation and amortization. And all of this, I've been talking about R&D, but when we think of other types of internally generated intangibles, we can think of a brand-intensive business. The problem here, I don't even know what advertising is most of the time. It's not disclosed on a consistent basis. So that's the problem with the R&D number. The other problem I've got is the asset life. Now, using industry average asset life is a pretty good starting point, but specific companies may have much shorter or longer asset lives. And there's also a time lag between the R&D expense and then when the R&D starts to generate revenues. So what this means is some of the older R&D is no longer relevant. I shouldn't be including it in my stock of intellectual property because it relates to products no longer sold. The information that will be useful here will be much more detail about the company-specific asset lives rather than just the industry average I'm using. Now, sometimes we do get a hint of this, and it's disclosed in the management commentary. For example, companies say, half of our products have been designed and are only 3 years old, or something like this. This information gives me a bit more information. On the other point, some of the recent R&D is not yet relevant. It relates to revenues that have not yet occurred. And I think of this a little bit like construction in progress. It's part of their stock of intellectual capital, but it's not being used yet. So to separate this out, it'd be very useful to know what the average project timescales are. Now, a lot of these problems actually in the pharmaceutical industry have been looked at, and there's a really interesting publication from Deloitte on pharmaceutical innovation, and they've published this since 2010, and it's based on late-stage pipelines for 15 large biopharma companies. And what they do, they calculate the internal rate of returns for the total R&D incurred to bring assets to launch, and then they use a forecast to estimate the future revenues for each of these assets. Now, when I first came across this study, I was really just surprised how low the internal rates of return were. As a generalist, I thought that pharmaceutical is a highly concentrated industry. Pharmaceutical companies have patent-protected products. Surely the returns, the IRRs, should be much higher. It turns out the IRRs, per the Deloitte report, fell from around 7% in 2013 to under 2% in 2019, and they've bounced back up to 7% in the last couple of years. And what they showed, which was very interesting, the decline in internal rate of return was due to a very large increase in the cost to launch, going from 1.3 to 2.4 billion between 2013 and 2019, an increase in the average clinical time scale, the time scale for the clinical trial, from around 6 years to 7 years, and also a fall in the peak sales estimates from around 520 million to 360 million. So it is possible using other information beyond the accounts. But unfortunately, in other sectors, such as technology, where R&D is also a very important type of investment, we don't have access to such good information. So it would be really helpful. What would be really helpful to investors in that case? Well, I think a much better disaggregation of the R&D number. Could it be disclosed by project or even by risk category? What investors want to know, are all of these low-risk projects just upgrading existing proven products, or is it this all blue sky products that are, much riskier with a different reward profile as well? So putting all this together, the conclusion is lots more information is not necessarily what investors want. We already have far too much to deal with. What we really want is information to reassure us that capital is being allocated wisely and invested in attractive projects. So to help us do this, I think we could have better non-financial information. And I've mentioned here a description of the capital allocation process and a description of the cultural attitude towards risk, and also better financial information. And this comes in better expense disaggregation, information about asset lives and project lives, and also an analysis of R&D budgets by project type and risk profile.
Thank you, Jeremy. Thank you for this start. And as usual, as everybody knows, shareholders have more questions than everybody in the world can expect, right? So the challenge to the rest of the speakers to come up with reasonable answers here. But good to hear that it's focused on non-financial information as well. And having said that, to create some more focus, as already indicated by Kevin, we'll focus here on the R&D side, in particular when it comes to the intangibles. And as such, I would like to give the floor to Dominique. And Dominique basically, will explain more how companies, of course, also internally evaluate very heavily, their R&D expenses, in particular when it comes to the pharma sector. So Dominique, the floor is yours.
Thank you, Henk, and good morning, good afternoon, good evening to everyone, wherever you are in the world. So as Kevin said, the accounting regulatory body are working on what kind of information could be disclosed about intangibles and R&D expenses in the future. And Jeremy just mentioned quickly what an investor would be interested to get as information. So I've tried to put on a few slides how it's happening in the pharma industry and why it's happening that way. To give a view to all participants about what is the magnitude of what we are talking about, here are a few figures about the pharma industry. The level of R&D spend is very, very significant. It's as an average for the top 12 large pharma company, about 18% of sales, ranging from 14 to 23. So for a company with revenues at 30 billion, it's more than 5 billion that are invested in R&D. When it comes to balance sheet, depending on the companies, again, the intangibles plus goodwill account for about half of the total balance sheet. And it's obviously depending on whether you are investing internally and developing products internally and your level of intangibles and goodwill is relatively low, or whether you rely on external partnerships and you invest a lot in external project and your level of intangibles is quite high. And when it comes down to price ratios, so PE about 17 and market to book ratio about 6, that shows that we get in terms of market cap a significant leverage compared to the book value. If we go to the next slide, the accounting for R&D is relatively simple. Here it's a bit theoretical what I've mentioned, but by and large it's true. When you look at it, internally generated R&D is mostly accounted for in the P&L. Externally acquired R&D is mostly accounted for in the balance sheet, either as intangible or goodwill. It's a general rule, obviously there are differences, but to make it simple and to understand that's where we are, internally P&L, externally balance sheet. If we move to the next slide, on the next slide, what is disclosed and what is available today for investors and readers of the financial statements to make an assessment. For internally generated R&D, there are limited disclosures that are done. You have the P&L, obviously, and you have the R&D line. When you look at the notes to the financial statements, you get some details by business segment, but you don't get a lot of information. When it comes to externally acquired R&D, then you get much more information. You get information about what are the projects. When a company make an acquisition or a license agreement, you get a press release with financial terms, financial conditions, and you can have a view of what is really the weight of the project. And there are also financial disclosures on the agreement itself in the notes to the financial statements with the content, the methodologies, the valuations that are used by the company. So you get much more information on externally acquired R&D. When it comes to CapEx versus OpEx, and we'll probably talk in the Q&A session about make or buy decisions, both internally and externally will lead to cash outflows. There is no difference here. And both type of projects will have to generate sufficient return. So for you and for all investors and all readers of the financial statements, the question is, what should be disclosed and what should be made available to third party to assess the value of the internally generated R&D? And that was a question raised by Jeremy, and I will give part of the answer. Here you have a list of questions that corporates ask themselves when it comes to evaluation of R&D spend. I will not go through all of them, but you have a list here of what are the measures, how it's done, how corporate evaluates the R&D capabilities when they look at potential acquisition, and once again, how do they make or evaluate the make or buy decisions. But as I mentioned, we'll probably come back onto it during the Q&A session. So moving to the next slide, some metrics are available in the pharma industry for internally generated R&D or internal projects. Jeremy mentioned the IRR, the internal rate of return, with two inputs, the total R&D by asset and the peak sales or forecasted revenue for those assets. We look as well in the for internal projects on the overall cost to bring an asset to market. And it's true that bringing an asset to market in the pharma industry, it's more than $2 billion for each asset. And for some of the assets, way more than Vessel. You all have to realize, if you don't know it or are not fully aware of it, in the pharma industry, R&D is a work that 99% of the time is a failure. You have 100 projects or 100 molecules screened at the very upstream part of the value chain, and you get at the I would say downstream part of the value chain only one product. So you really need to look at each asset and what is the cost to bring an asset to market. Forecast of peak sales per asset is very significant as well. Cycle time, it's a non-financial measure, but how long it takes for each of the phase 1, phase 2, phase 3, phase 4 clinical trials, and how far you go, how long it takes between phases to publish results, to look at them, to analyze them, and to get to the regulatory filing. If we move to the next slide, we also have some other metrics for internal R&D, commercial value versus scientific value, and what is important for prioritization of assets, for definition of what is the true value of an asset, how much scientific advantage it brings, and how much commercial value this asset can deliver. We look as well at the cost per clinical asset and cost of clinical per asset, either per patient, per disease area, depending on where you are, because it's more costly in some of the disease area versus others. So it's really important to look at asset by asset. We look as well at the cost of assets for co-developed assets, assets that are either in licensing, in partnering, because in all licensing situation, you have to pay some royalties, you have to pay some milestones, and when it comes down to valuation of those internal projects or projects that have become internal after a licensing agreement, you need to look at the whole contribution and whole financial burden on the long term. pharma companies are also looking at the number of assets they have per disease area, so that they can give confidence. And it was one of the words of Jeremy as an investor or as an investing party, how you can give confidence to the investors about your assets. So all that is available internally in an R&D in a pharma company. The question is how much of this set of data you should disclose externally. Today it's fairly minimal. How much it should be and how valuable it would be to do it in the future is a question that needs to be sorted out.
Thank you, Dominic. And I think it's good to hear for Jeremy, but also other, let's say, potential shareholders or shareholders that the analysis being done within the companies are going in the same direction as Jeremy was expecting. But that the key question is what you put on your last page, right? Next, I would like to bring it to Ralph, a representative of DSM, a company that has gone through a fabulous journey over the last decades, also, including yesterday. And the key element of that journey has been that, the company has become more and more R&D intense. So Ralph, give the floor to you.
Appreciate the opportunity to be here today and share a couple of my thoughts. And before diving into the content of today around intangibles, a bit on our journey. Today, DSM is an active company in nutrition, health, and bioscience, and Henk alluded to it. Pretty proud to announce that the merger with Firmenich that we made public yesterday. And I'll come to that because that's an interesting feature as well when we're talking about market to book and the development of companies. Let me flip through a bit on DSM. We look at some of the challenges around food commitments and food systems today. I think we've got some very capabilities that can apply that, and we've actually introduced the science in that dialogue and made it an integral part of our strategy, and also basically linked that to our financial targets. And there's two accolades there in the light of innovation, and that's subscribing to the importance of the topic today. We're now at the stage, and Henk alluded to that, we're on this journey where innovation becomes a more prominent part of who we are as a company going forward. Financially, we made that explicit to our stakeholders that in terms of our growth ambition, we have a mid-single-digit sales growth ambition. Out of that, we expect innovation to contribute 1.5% from that. And in terms of our profitability growth, we have a high single-digit ambition in that space, growing our EBITDA annually with a high single-digit number. Of that, 2.5% should actually come from innovation. Now, if we go to the next, we've done that. We're moving more and more into that space. We developed 4 key themes where we focus our innovation on. We won't go into that also in the interest of time, but what you can see in that journey that it becomes more and more targeted, and we'll spend a bit of time on how we then assess how to make the trade-offs between R&D projects and how to translate that into intangibles. Overall, as a group, we spend around 340 million today, around 5% of sales. Jeremy alluded to that. Is that a good number, a bad number? In the end, it's also used from a peer-to-peer reference, and I think Dominic alluded to it. It's interesting to see the comparability between companies requires actually a much deeper dive, because you can take certain views. I saw some of the questions popping up in the Q&A around how do you then assess the probability of success, and those are all key decisions that will determine the decision moment under IFRS, which applies to many European reporting companies. At some point, you would actually have to capitalize, but obviously your assessment around probability of success gives you flexibility. And some companies take a more prudent approach and expense a cost. Others have a preference for capitalization and an amortization over time. But take 2 companies, compare them. One has expensed this, one has capitalized it. Obviously, the return on capital going forward will look different because one has treated it as a sunk cost and took a one-off expense in its P&L. The other is actually capitalizing it, reducing the market to book, But on the other hand, metric like return on capital and the like will look different going forward. And then do you compare a company's performance based on its EBITDA or based on its EBIT performance? I think those are criteria to go. Down here, a bit how we translated that. We communicate our ambition externally, and we'll come to that later on because there's some concerns or challenges around that. But I also wanted to highlight a few of the topics and what we call lighthouse projects, where you are a bit more vocal on externally. And the first one, it's the above one, it's a Bovaer product. A lot of what a lot of people don't know is that a lot of the methane and carbon pollution in the production of milk is actually produced by the cow itself by burping. Now, DSM is a solution for that. But the interesting piece is that there's very little on a balance sheet today, but obviously has a promising value and is captured into our share price today. But I'll come to that with some interesting insights as well. If we then move to the next, we've been on this innovation journey, and instead of Germany you spoke about it, where the engineers had the power in the company that you refer to. It's all around one-off ideas and science, and a good idea translates into an innovation, but an innovation doesn't translate into a commercial success. And I think we flipped that around. We made integration or innovation part of our business and took an integrated approach. It has to be linked to the strategy. It needs to be balanced, be mid and to short term, but also a balance with long term. It needs to have lighthouse projects because there's so many projects that you can actually handle. But at the same time, we're looking at it integrated way in venturing and M&A. And there's a different way of looking at that. But the point and the key takeaway is that innovation will become more and more prominent in all of the companies that we do. And you see also the unicorn companies popping up. They all come up with something innovative and basically are translating the space in that they operate in. And that has basically led to a lot of focus on innovation. Now, this is a busy slide. I will not go through that in detail, but it's a bit how we now basically approach innovation, but moreover also assess the various projects in our pipeline and that are relevant to us. Now, in the pre-discussion with Henk, he asked me to highlight a few things. And the first thing I want to highlight, and Dominic had it on the slide as well, you look at the NPV, you look at IRR, but how do you actually do it and how do you differentiate? What are the risk profiles that you apply to the projects? And there, the first big difference is already between M&A, internally capitalized R&D, internal developed projects, and M&A. Internally, we apply to all of our investments. We have a hurdle rate of 20%, and we also calculate an NPV on 20% because we don't see that the differentiation in discount rates is helpful, because if you want to assess the various choices that a company can make, you at least want to have a few of the metric comparable, that when you talk about an NPV and when you talk about a return, that it's at least comparable. So within our company, we apply a 20% flat rate. However, when we look at an M&A, we often use the cost of capital of the company, which is substantially lower. And here you are at a trade-off point where you say, on the one hand, I can start developing it myself. At the other hand, there's a company available that has the technology that you want. Also, the treatment is then different. The other one will take you time and effort, which will flow through the P&L initially, which will basically pressure your EBITDA. At the same time, if you can acquire something, a lot of it is capitalized and it goes into intangibles and will flow. Part of it is amortized, but that's also typically a limited part. There's also a big chunk in goodwill, which will just sit on your balance sheet for quite some time. So it's definitely a deciding factor in terms of doing something yourself or basically acquiring it. At the same time, the metric that Dominique showed resonate well. You look at peak sales and the like in terms of assessing how to assess the various projects that are on hand. Now, there's a few topics that are key to highlight. M&A versus internal, we talked about. Capitalization versus expense, very much a preference of the company. Of course, accounting rules come into play, but the minute you capitalize something, you can also have a long-term view and the like. And the interesting factor of that is that once you are on a project, I think one of the questions in the Q&A was, how do you then assess the probability of success? it's a bit of a cruel thing in terms of going through a project phase. Typically, initially, there's a cash out and the expense is made, and then your probability of success is increasing, and also your NPV is increasing because part of the cost is basically sunk cost. And that is often the approach taken in innovation space, that your probability of success actually increases. And I think that is something that, in terms of also explaining into the external world, is definitely a challenge, because even if you burn 100 million up front, then your probability of success and expectation is increasing, because you basically have taken a big part of that cost already. Now, different valuation for different purposes and different rules. Doing a PPA on an M&A provides certain rules and regulations, discussions with your accountants, and the same thing you can apply for assessing internal R&D. If you're an optimist in the world and you've got a good probability of success and a return, you're closer to capitalization than others. Now, is that a good thing? Maybe not, but once you've made that choice, you basically stick with it. And I can give you an example from own experience. We were active in biofuels, and we had quite a large capitalized R&D, but also investment. We made pilot plants and the like. Ultimately, the venture didn't turn out, and we had quite a big impairment. Now, is that then a better company where you say, okay, my gap from market to book is smaller? Is it better insight because I provided insight in the asset? I think you have to have a deep dive in those various topics to make it comparable, but also have a true understanding of what the R&D effort of a company actually means. And that's the same thing. Some call it R&D, some call it innovation, some call it process improvement, closer to manufacturing, and some call it application development, which is actually closer to a sales expense. So R&D in itself is not fully conclusive, and I think that is all something you need to take into account. And often when looking at intangibles on the balance sheet, I mean, often a big chunk is customer relationships, brands, and the like, which are a fluid topic in itself. Look at ourselves. We've had an endless debate within the group. Is there anything possible? The DSM brand has a fantastic value, but it's not reflective on your balance sheet. And yet here we are on the front of a merger, bringing two brands together, and what to do with that. So that in itself will give you its challenges as well. Let me close off with the importance. When we go to the last slide, it's a copy from our investor deck that we presented to the world on Tuesday. But I wanted to highlight both bottom metric. The number of patents, the number of R&D centers are quoted there, just subscribing to the importance of this topic, but also the less comparability of it amongst peers and amongst companies. And I think it's food for an interesting Q&A. So maybe with that, back to you, Henk.
Thanks, Ralph, and indeed a very interesting journey. It shows that R&D is getting more important also for you guys going forward. Dominique, can I give you the floor to talk a bit more about the topic? How do companies within pharma, in particular, right, evaluate their choice between internally developing their R&D further versus acquiring an R&D?
Yes, it's a very important topic because, as I said, the total amount of intangibles plus goodwill in the top 12 pharma companies is about 50%. So it means that there is a lot of externally acquired R&D compared to internally generated projects. And in order to evaluate internal versus external, there are very different criteria that are taken into account. Financials, obviously, but also accounting, and the fact that for internal projects, you put it in the P&L, and external projects, you put it in the balance sheet. Sometimes the accounting principles could have, and sometimes have, an impact on the decision for going externally. And you also have some very scientific criteria, such as the breadth of the portfolio in a given disease area. If you want to replenish your portfolio in a given disease area, you will go externally if you don't have enough, I would say, follow-on compounds compared to what you have already on the market. So financials, it's a given. You look at it and you look at the return on investments that those projects will lead. Accounting and scientific dimension. The value of a pharma company, when you look at the market cap and the various, I would say, ratio you could have on the market cap, the value of a pharma company is in its portfolio. It's obviously part of it is on the currently commercialized products, but the financial analysts are looking at 5 years ahead, 10 years ahead, 15 years ahead, and they give a huge value to the portfolio, to the point that when you have a failure, you see immediately the impact on the share price, and you have a drop in the share price when you disclose that on a quarterly basis or whenever, that you are stopping some projects because they have not met their clinical endpoint, and you see the impact on the market cap. So clearly, the scientific dimension is a critical item in the decision.
Thank you, Dominic, for evaluating all these things, even including the impact, which may come to some surprise of accounting on that decision. And maybe Jeremy, you would like to talk a bit more about that choice and how you see it from an investing perspective, the make or buy decision.
Oh, thank you. Well, to answer the question, do I prefer make or buy? I think I generally prefer make, because I know a lot of studies have shown acquisitions on average destroy value over time. But I'm interested in Dominic's comments that the accounting dog could kind of wag the economic tail. And I came across a non-executive director once who told me about the accounting honeymoon. I said, what's that? He said, well, after an acquisition, there are so many things the finance director is able to do to make sure their adjusted earnings number hit their key performance indicators, and the management get paid their bonuses. And we know they're the purchase price adjustments, excluding restructuring and merger expenses, adopting new accounting policies. So I would, I'm always on the lookout for that potential source of bias.
Okay. Thanks, Jeremy. We also touched upon the topic of, let's say, risk evaluation of R&D, right? And how that risk evaluation should come about. I would like to discuss that topic also a bit more. And maybe, Kevin, you can say something about, quantification when it comes to, let's say, that risk element of R&D projects.
Yeah, thanks, Hank. I think in that acquisition context, I think it's a lot easier because you have kind of baseline metrics to draw upon. So you have the deal IRR, you have and various kind of other kind of diagnostic tests that give you kind of a baseline with which you can evaluate that. So I think from the acquisition context, there's still a range of kind of reasonableness there, but there's a lot of kind of goalposts that help you with that. I do think in the kind of the internally developed arena, it's a lot more ambiguous. I think from a valuation perspective, we have some research and some rules of thumb, but a lot of those are pretty outdated and are pretty subjective with very, very wide ranges of discount rates to use. So I think on the internal side, it's much more difficult. And Ralph, I'll put you on the spot here a little bit, but I'm curious. You guys referenced the 20% for the kind of internal hurdle rate. Curious if that's kind of a mosaic theory or more qualitative or more quantitative with maybe where that policy came from, and if that's something that changes over time.
Yeah, no, thanks. And it's a good question. Now, the 20% is just a hurdle, which is high enough to at least make sure that you don't get involved into projects that are closer to that number, for simple reason that experience tells you that typically the sales effort is underestimated and equal for the overall cost to bring a product to life. So we're saying it needs to at least surpass that hurdle, otherwise we're not even considering it, because then we've got basically alternatives out of the business which come at a much different risk profile for us to invest in. Now, typically you do see that the projects come out a bit higher But here for us, the probability of success linked to the hurdle rate is at least as important, because I think we all have the experience and understand Excel well enough that the business case can be tweaked such that a certain hurdle is met. But I think here we have at least from within our company, we look at typically at 9 criteria, all varying from the cost to market, the marketing and sales effort, do we have a production asset or not? And we all rate those on the metric 1 to 4, also not too complicated, just from very challenging to very capable. And with that, you basically translate that into a number which we call the probability of success, which is a bit of a factor that we apply as well. And that combined with the metric that are commonly used, like peak sales. When is our year of peak sales? How long does it take to actually contribute to our top and bottom line? Is then basically the assessments that we do. But then the 20% as such is at least making sure that we don't look at good ideas that in the end don't necessarily contribute and are not balancing the risk reward properly.
Yeah, thanks, Ralph. And it makes sense, right? I mean, it's good to have a minimal hurdle rate, but we also should not put too much, let's say, emphasis on estimating a discount rate, whether it's 21, 22, or 23%, because a key input there is, of course, the relevant cash flows that come out of it, right? So stuff like, let's say, peak sales, probability of success, that is probably where much more business insight can go into than necessarily making the discount rate too much of a black box here, right? Because comparability is one thing, but it's also a way of not overdoing it and making it scientifically precise, because everybody knows that is not going to happen, and that's also not realistic. Maybe can I use the last few minutes on a key topic, right? That's also come to the meeting here, right? Which is there's a preference, clearly for much more information from the investors. Let's even call them the principals, right? I mean, the people that provide the money to the entrepreneurs to do the R&D. And there's the a trade-off on the entrepreneurial side, on the corporate side, and how much, as Dominic put it clearly, how much could and should be shared with the outside world. Maybe Dominic, can you elaborate a bit more in the few minutes we have on that clear topic? What's driving companies there, what to disclose and what not to disclose?
Yeah, it's an important one. Before answering, I would like to highlight that there are already some existing sources of information. For clinical trials, for instance, in the pharma industry, you have a website in the US called clinicaltrials.gov that gives you the detail of all clinicals per products, and the detail of the clinicals, the number of patients, and many information. So when you look at it, the information doesn't come only from the company itself and from its financial statements or its press release or any other source of information, but you can also find some information externally. Now, the dilemma in all that is the level of transparency versus the confidentiality, and more than confidentiality, I would say the competitive edge that it can give. We know that we are in a highly competitive environment, irrespective of the segment, and competitive information is an issue. I know we should not hide ourselves behind a competitive threat, but very often still it's a good argument, and it's something that is, I would say, preventing companies from disclosing too much. However, there is much more that can be done, and what is important in the pharma industry is the cost of clinical and the duration of clinical. So any information, additional information, investors could get on cost of clinical, number of patients, duration of the clinical trials would help a great deal in making a more, I would say, orientated assessment and valuation of the assets.
Ralph, would like to add some more aspects there from your experience?
No, I think a lot of it is said. The confidentiality is something that I would say as well, but also the managing of expectations as well. The minute you are very vocal on those expectations and very transparent, you end up in a discussion on what is the outcome, what is the expectation. You promised us 200 sales by 2024. What is the status? Are you contributing it? Are you on schedule? Yes or no? And at the same time, we're talking about R&D and innovations, and we all know it's not a safe world or a safe investment. And I think, Jeremy, you alluded to it, your preference is, or you get a perception on whether a company is taking excessive risks or not. And in that sense, companies want to get a clear guidance on the financial performance, on the financial outlook of a company. And innovations create excitement around what the company stands for and what direction you are. But the minute you start holding companies accountable, saying, yeah, but you invested 100 million in this venture and you promised me X, Y, Z, and now it's a year delay, does that have an impact on the valuation of the company, or was that an inherent risk that was included and baked into the financial forecast of a company anyway? And I think with that, it's just creating volatility. And given the fact that volatility is there and often perceived as negative, it's an additional hurdle on being very transparent on where and what goes the money in terms of expectation setting as well, Henk.
Thank you. And that brings us to the end of this session, everyone. I mean, I do hope that everybody had a clear idea now how relevant information is about intangibles when you want to analyze them further, right? I mean, and Jeremy, from a shareholder perspective, clearly put to the table that, more information, and particularly, some types of information would be very helpful there. We hope from an IVSC perspective that you guys in the audience, got more information, at least on the topic that was disclosed, right? So that's a good thing. And from a core perspective, when you talk to shareholders, you better talk about risk when you drink a coffee, because then Jeremy is happy with that, as he indicated, right? I mean, if you drink coffee and talk about the family, that will give him a good idea about the risk perspective. So what we will pick up as a challenge from the IVSC, Kevin and I, is that what of course is important is to do some checks as to whether companies that are more transparent when it comes to providing information, whether those companies, for example, have a superior share price performance, right? I mean, there are several ways of also trying to challenge the companies by seeing if more transparency will lead to, let's say, better share price performance. So having said that, I would like to thank everybody for contributing.